Web3 CFO, I mean to figure out things like how custody works, how to use DeFi platforms, on and off ramps, token economics, if applicable, or how to manage their payroll and expenses using crypto. So there's not a single space where you can go and learn treasury management. So today we're lucky to be having 3 experts and members of the club who've been working in crypto for quite a while now. We have Oren Rosenfled, the CFO of Fuse Network. Fuse is an enterprise-grade and EVM-compatible public blockchain. We're joined by Kevin, the head of finance of Safe, previously Gnosis Safe. And Kevin was also the previous CFO of Aave, a data storage blockchain protocol. I'm sure everyone knows Safe, so I won't say what Safe is. And finally, Nick Pletikos, the head of treasury at Sweat Economy. Nick has been releasing some fantastic articles on treasury management on his blog. I'm going to be sharing the link here in the chat bar. I'll do it shortly. And those articles have really helped me to prepare the webinar today. And Nick is also the co-founder of Cova Finance. Cova Finance is a decentralized insurance protocol, and Nick regularly advises Web3 projects on their token economics. So before I go a bit about what the Web3 CFO Club is about and share a bit the agenda of today, why don't we start with an intro from the speakers themselves? So Oren, can you start and tell us a bit how long you've been at Fuse and share a bit about your role at the company?
Yeah, sure. I'll be happy. Thank you for having me today. So I joined Fuse about almost 2 years ago. And Fuse is we're just celebrating our 4th birthday this month. So there is a lot of activity on the community for this anniversary. So I joined Fuse after almost 15 years in the traditional finance roles, both in traded companies and in private companies, and mostly in the tech arena. I find it fascinating, and what I'm trying to bring on to Fuse is to do this merge between the old school finance fundamentals and the new crypto industry, and when this industry is coming to maturity, to have real companies and not just projects, but doing real things, and having in mind that we are kind of a traded companies from day one when we are launching our token. And there is a lot to do when you're coming, as everybody knows in the club, there is a lot to do when you're coming to a company, to a Web3 company, and putting everything into order, and all the processes and accounting and treasury management is part of them. And we're going to speak about it probably in the next hour or so.
Thank you, Oren. And Kevin?
Yeah, also, hi everyone. It's a pleasure to talk to you today. My name is Kevin. I joined Safe roughly close to 12 months ago as head of finance. I basically oversee here with a particular focus on the Safe Ecosystem Foundation, our DAO wrapper, let's say anything in the arena of financial management, treasury management, but also compliance management. I also have certain responsibility for operations. This includes HR, and in particular HR, as we of course are also growing, and HR of course essentially is also a very key player in scaling up our network. Well, I think, as Oren said, right, I think my motivation is very much bringing in my past. I used to be originally a tax lawyer, and that's also how I basically stumbled into that space. I was advising in 2017-18 in Switzerland, a project launching their token networks, and I kind of stayed on, was infected, and just wanted always to bring in my professional experience, having been a Big Four educated professional, just to make sure that when approaches are growing, scaling, that compliance is not missed out on, because in the end, I see myself very much also as a bridge builder between Web3 and the traditional world. And that's super fascinating. And since also a couple of years, I'm also involved in tax and accounting working group at the Crypto Valley Association, help also to shape up, in particular in Switzerland, tax accounting rules for crypto. as we need we all need more clarity, legal certainty for our industry to keep building and growing.
Fantastic. Thank you, Kevin. And finally, Nick.
Yeah, hi guys. Thanks so much for having me. So I joined Sweat Economy actually after their TGE in September last year. So it's been a bit less than a year. But I've been involved full time in crypto since early 2019. Back then I joined Bitstamp, Bitstamp decentralized exchange, and I was actually one of the team members who practically designed the whole treasury department from the ground up, because back then it was practically non-existing in crypto, and we essentially took the banking framework and tried to apply it to crypto. So I spent there roughly 4 years. I've been 1 year at almost 1 year now at Sweat Economy, where I'm responsible for managing the treasury and also optimizing tokenomics, managing the native token and all this stuff. But yeah, as also other guys said, as natural path went, I started in treasury in insurance companies, so a very traditional one, let's say. Then I moved to a centralized exchange, which is somehow a bridge between let's say traditional finance and crypto, and now in the Sweat Economy as a decentralized app. That is more, let's say, native crypto one as such. So yeah, that's very briefly about my background.
Thanks, Nick. So about the webinar today, we'll go through that's the agenda. We'll speak about counterparty risk. We'll speak about the optimal allocation for fiat and crypto. How do you go beyond crypto to generate yield in TradFi using Tbills and ETFs? And finally, we'll touch on what's the role of the Web3 CFO for Treasury Management, because like I said in the intro, there's a lot of new responsibilities that the CFO in TradFi doesn't have. And lastly, we'll have a Q&A. So we'll keep the questions at the end. Hopefully we have time for Q&A. Of course, I have to always mention the disclaimer that the content here is for general information purposes only, and is not a substitute for consultation with other professional accounting, tax, or legal advisors. About the Web3 CFO Club, because I understand today we have some non-members as well watching us, so I thought why not share a bit about what the Web3 CFO Club is about. So we are a community of finance and operation leaders in Web3. This club has been created by Request Finance. Request Finance is a crypto application or platform for crypto invoicing, payroll, and expenses. And with this community, we have mainly two objectives, which is basically to share best practices for Web3 financial operations and to allow yourself to network with your peers. We have 640 plus members today, and it's growing really fast. I won't speak, just about myself very shortly. What's my role? I'm helping to grow this community and organize different initiatives like the webinar we're having today. We are going to be organizing a side event at Token 2049. I still haven't announced it, but hopefully it's going to be very soon. Now, before we start the webinar today, I want to invite Ivan to share a bit about the Treasury Management Guide, which is going to be published very soon by Request Finance. So last year we published the Web3 CFO Guide, and this year it's going to be the second version of the guide, focused entirely on Treasury Management. So Ivan, could you share a bit about what people can expect to learn with this guide?
Yeah, sure. I think it's very much going to be similar to a lot of the topics that are going to be covered by some of the speakers here today. In fact, I'm very interested in seeing if any of that could be featured in the guide as well. I think it's exactly like what Umar introduced. There's a lot of literature out there on treasury management in traditional finance, right? But a whole bunch of it is either, well, semi-relevant or just doesn't translate directly to crypto and DeFi primitives. And there's also a lot of differences in the tooling stack. So I think I'm focusing on two things, right? One is the best practices and how we translate some of those best practices from traditional finance into the realm of DeFi and treasury management and crypto assets. because we don't have to reinvent the wheel, right? So I think some of that is translational work. And then the other thing is actually covering, what are the new asset classes that are on chain? What are the new sort of like avenues for allocating capital that I guess people can think about when you're managing a crypto treasury. So that's more on the tooling side of things and also on the capital allocation and budgeting. And beyond that, I really look forward to hearing from all of you. I've also reached out to some of you about becoming contributors to the guide. We are looking to launch it in the second half of September, so it's not a long time to go. But if you'd like to become a featured contributor and share some of your insights around treasury management, your experiences around tooling, service providers, or how you think about the back office stack for treasury management, feel free to reach out to me.
Thanks a lot, Ivan. Just one last thing. How can people reach out to you, Ivan?
Oh yeah, I put that in the comments. So you can reach out to me on Telegram at Ask Ivan, and you can also reach out to me via email.
All right, thank you. All right, thank you. So we can start with the first topic of the day, which is about counterparty risk. If we learned anything from last year, it is that counterparty risk and absolute trust in third-party custody is dangerous. So in light of those companies like FTX, SVB, Celsius, BlockFi, and others going down, since you've taken your roles being a CFO, head of finance and head of treasury, respectively, what's been some of the learnings when it comes to managing counterparty risk? And are there some precautionary measures that you've been taking? Maybe I'll have, anyone can start, feel free to start. Oren?
Okay, I'll take it. So I think that when I came to crypto, the essence and the idea of crypto was to decentralize everything and be your own bank, and to be responsible to your own funds. So I find the idea of putting money in custody really counterintuitive to crypto. So when dealing with crypto, I try to manage it in a way that I hold as much as I can, in a self-custodian wallet. It can either be cold wallets, Ledger, Trezor, whatever, or just wallets that we are using. There are many solutions today in the market for self-custody. It can either be, Fireblocks, for example, or other new companies that dealing with highly secured wallets that are built for companies. So I think that we as CF, we are not private people. We're holding other people's money, and we should be responsible for that. And I don't think that companies should be exposed in any way to the next FTX, if it will ever happen. It's still sometimes more comfortable to use these centralized exchanges for swapping or bridging, but we shouldn't hold money there for more than a fraction of a second. That's what I think. Regarding banking, I'm coming from Israel, the banks here are pretty stable and covered by the government. In the States, we know what happened to SVB and Silvergate. I have to say that I'm still using SVB. It's still kicking alive, just to let you know, guys. So you can still use it. And as Nick wrote in his article, you should have more than one bank, that's for sure. But the idea for me is just to hold the funds, first of all, to have funds both in fiat and in crypto. And when we start thinking about crypto, it should be in stable coins and in tokens like Ethereum or Bitcoin, like the big tokens. And it all should be according to a policy. You shouldn't, as a company, we are sitting, we understand how much we want to hold, what are the proportions. We can say, for example, which is not very far from reality, we're gonna have half of the money in fiat, half of it in a stable, 25 in stable coins and 25 in tokens. And then to manage the exposure, if you get revenue in different tokens, to know that you need to swap it according to your policy. But like always, just to have like many options and many providers that you're using in order not to put all the eggs in the same basket, and not to use, let's say it in a gentle way, not a reputable stable coins. Like when I'm going, I have to admit, when I'm going to USDC, I feel comfortable because I see the reserves every day, every month. They are audited by Deloitte, and you can feel comfortable that USDC is pegged to the US dollar. And then just hedging, because I'm using both US dollars and new Israeli shekels, I need to manage this exposure, but this is totally a Web2 traditional hedging that we need to make. That's my take on that.
Thank you.
Yeah, I think I fully back what you said, Oren. I think like what you kind of, and then now also talking from a perspective of a regulated DAO wrapper, right? And I can gladly also add a couple of observations from the Swiss banking market, which might be not so intuitive. Like, first of all, I think it really calls for a proactive approach, because like if you're cornered, you're not left really with a lot of options. So I think you need to really plan ahead. Always I think what you just said on, right, like have a certain balance between fiat funding funds and crypto, right? When it comes to the fiat sphere, diversify across various banking partners. Ideally, like for example, also have, when it comes to topics of business continuity, have certain funds ready on, for example, paying rent, contract fees, employees on a different account. Maybe you do, maybe, for example, treasury management in fiat. The fact with regard what's also unfortunate fact is with regards to the fiat sphere, there are not too many options left. And also, like if you look at FTX at SVB in the end, it's really hard to say, of course, yeah, how to trust like banks, right? Like for example, I'm Swiss, right? And we had next to SVB, I think it was then a week after, we had basically, on Sunday night, the government rescuing Credit Suisse. And, we talk about two global banking giants basically, which were forced to cooperate and entering into that merger. And nobody would have expected that, to be honest, right? And I think I would have had no doubts to have maybe certain funds with Credit Suisse before, but it shows you cannot be secure. You need to be always alert, on the alert state, or think about that something can happen. So it's really about counterparty diversification. And of course here also like stablecoins play also into that thinking. On the other hand, well, I also recall the weekend in February, I think, if I'm not mistaken, where also like all of a sudden the USDC was depegged and people were running around like crazy. And of course, we try to stay cool and focused on the essentials, but still it also certainly like brought up some other considerations. I think self-custody is always a way forward. As a regulated entity also means like you need to really step up your game on, for example, internal control systems, right? That's for a startup, not an easy challenge, but it's a challenge worth fighting for. And last but not least, we also benefit from the Swiss laws that, for example, allow banks like Signum or SIBA to actually offer crypto custody. Whereas if the bank goes bankrupt, these crypto assets do not fall into the insolvency basket. This is actually a tremendous advantage. Of course, it doesn't help you if they fuck up. Sorry. I don't know when I need to cut this out. If they completely mess up, of course, custody work, but like at least it's also like another aspect speaking in favor of diversifying into stablecoins. But again, also think about, you also have a counterparty risk there. And I also agree with Oren. In the end, of course, USDC is a strong stablecoin. Is it super secure? Well, we shall see, but it's certainly one of the better ones. And we have also seen what happened to DAI, for example, in those days. So yeah, it's challenging, but also equally interesting. So to end this comment on a positive note.
Yeah, definitely. I will only add two things. So definitely keep the balances on decentralized exchanges at minimum, right? Because we saw what happened with the FTX. There were quite a lot of projects, particularly built on Solana, that helped probably 100% of their treasury in FTX, and they went under following the, let's say, the fall of the FTX. So you can't trust anyone really there. And on the other hand, usually, if there's a smoke, there's a fire, right? So usually, if there's a rumor, act fast. Try to take out the funds, whether this is a bank or a crypto exchange or I don't know, custody provider. It doesn't matter if it's fake news. You can always deposit funds back. But if you're, let's say, left behind the others, and usually they're in a mess, and you can't pull the funds out if something really happens, right? So usually the first ones to act, they manage to pull the funds out, and they actually have a liquid source of funds there. But if you're left behind and you're, let's say, in the group with others, then even with the banks in the US, also the FTX, there is some funds that are actually seized, but you can't really access them, and it doesn't help you if they're locked for another year or so, right? Even if they are yours there.
But actually, so it's just as a reaction, also just what you said, Nick. I think in the end, it's also like fascinating, right? I feel like every day I look at, whenever I look at this questions internally, right? And if I look back over the last couple of years, there's never the perfect solution, because there are always trade-offs. Of course, you can really fully decentralize your setup, but then, for example, it can, and again, I'm speaking from the perspective of a regulated ecosystem foundation, how to make sure that the funds stay bankable, for example, right? Especially if it involves large amounts, right? And I think we might talk about on-chain investment products later on. This is, I think, also to me like super fascinating. Equally, like it always leaves you up with the conclusion. Well, you always need to watch out, right, and look for the best optimal solution.
When we're talking about banks, I totally agree with you, Nick, that when you hear the first rumor, you might want to be the first one that takes the money and running away. And maybe that's what caused, by the way, the collapsing of SVB, because everybody thought so, not because they had a tremendous problem. On the other hand, when we're looking on February, if it was February, that the USDC was unpegged, if you have fundamentals and like if you trust Deloitte or whoever was auditing Circle back then, if you trust them that they have the reserve, so probably all the depegging was just because of panic. And then if you were just liquidating all your funds there, people might lose like 5 to 10% on the stable coin and just shorting their runway by 10%. That's a not nice thing to do. So most of the time it's right that you need to follow the rumors and just to act fast, because then you have your funds. But sometimes I think that we can be more relaxed and not laid back, but more relaxed if the fundamental is saying, yeah, there is money on the other side. And I think that everybody in the panel trusts the US dollar as of today. Okay, if we think that the dollar is going to collapse tremendously in 10% in a day, that's a whole different story. But we should be alerted as a Web3 CFOs. We cannot just trust everything all the time. But I'm going back to the beginning, like the idea of blockchain is a trustless technology. So we should just use the technology that we have.
Yeah. Oren, a few weeks ago, you shared this interesting article on our Slack on how Phantom Foundation, they managed their treasury after fundraising back in June 2018. The article basically goes through how they were frugal with their expenses. They prioritized like very essential expenditures. They decreased salaries. They had a marketing freeze. And that's how they were able to reduce the burn rate of their token and extend their runway. So ideally, the project's native token, if the project does have a native token, should not be used to fund or cover the project's runway, right? So there's not a one-size-fits-all approach when it comes to having an optimal crypto versus fiat allocation. But I want to ask you guys, in terms of your respective experience and at your company, what's some of the objectives of, or how do you see having an optimal fiat and crypto allocation?
I just want to share with you why I shared this article with you guys. So I was reading this article and I said, okay, we are like accountants, lawyers, CFOs, VP finance guys, and we are very conservative usually. And I was thinking to myself, am I the only CFO that is not a DeFi wizard that using his treasury to do like 40% annually? And like I felt uncomfortable when I was reading it. And I shared it with everybody, and I was so happy that most of the people said, yeah, this is like, it succeeds, but on the same way you might want to buy a Tesla stock or a GameStop and having like 10x on your money. And most of the people felt uncomfortable with that. And I'm happy that this is the situation. And I thought, okay, so we are back to normal. Yeah, I can absolutely understand cutting expenses, but playing with the treasury, if it succeeds, you're doing very well. But if it was not a bullish market, but a bear market, it could be a sad story. That's what I think. So playing with expenses and being efficient sounds great to me, but playing with the treasury, I'm not talking about like Tbills or the interest that you can get in the bank. Today in Israel, you can probably in the rest of the world you can get like 6% on the dollar deposit with a zero risk. But playing with the treasury, I was just trying to understand that what the community thinks about it, and just to make sure that we are all on the same page. And I was so happy to read the reactions to this article.
Nick, like Sweat Economy, also you have your native token. What's been some of your approach to having that optimal fiat crypto native, also native token allocation?
Yeah, so if I first add upon what Oren said, and based on this article, that's, let's say, an example of a successful, gambling, if I say so. It's not purely gambling, but it's a risky type of investment, right? But there are like probably hundreds of projects that went under during the 2018, 2019 bear market because they were overexposed to either the native token or Ethereum. Most of them were, let's say, back then raising funds in Ethereum, right? And Ethereum went down probably 80-90%. I don't recall at the moment, but it went a lot. So if you had like a runway for 4 years, then all of a sudden you have a runway for 2-3 months, and the bear market lasted a few years, and you were run out of funds, right? So that's some of the projects actually succeeded by trading and let's say swapping the funds to other tokens, but most of them were left, let's say, without anything, without run. In the Sweat Economy case, we still, let's say, we have our native token. For the time being, we are using it for our, let's say, ecosystem operation and the stuff that actually happens within the app. So we are not, let's say, converting it, because we also have like a portion of funds in stablecoins and fiat that we got from our fundraising, right? So I'd usually say that it's not healthy, to sell your own token if you don't have to, because essentially you're selling your token against your community, right? And you're showing either there's something wrong with the project, or you run out of funds and you have to do it, or your incentives are, let's say, wrong from the beginning, right? So it's not really a good approach. Of course, if there's, let's say, a strong bull market, it's wise to sell a portion of the tokens, but without affecting the price, or trying not to affect the price or the token holders as such, right? This is particularly an issue with smaller tokens with smaller volumes, or as volumes are now. If you try to sell either even, let's say, 10, 20K worth of your token, you will move the market down for sure a few percent, because it's a very, very shallow market, shallow order book at this point, right? So yeah, but if you hold like a treasury, or if your treasury in USDT or stablecoin, is pretty low, then you practically have no choice at this point if you want to make it through the bear market, because there are a lot of projects that are raising pretty small fundraising rounds, let's say, because as you all know, the fundraising space at the moment is pretty bad, or let's say it's pretty quiet, because it's essentially a bear market. So it's hard to raise like the valuations that were the projects were raising a year or two ago. They're raising like 5-10 millions pretty easily, and you have enough runway to hold you through a few years' time, right? But at the moment, the projects are raising probably a few $100,000 that only last you probably up to a year if you're like really, really cost savvy. But you can't do much with those funds if you run out of them. So what's the other solution is that you try to sell a portion of your native token. But yeah, it's usually I'd say that it's the worst case scenario, right? If you don't have any other option to bring in the funds and you want to, your project to survive, you essentially have to do it.
Yeah. I also fully agree with this perspective, because like in the end, for example, in case of Safe, right, our token is not yet transferable. So the DAO treasury diversification discussion has not yet started, so to say. We basically have the funds we raised through the fundraise from last year. And essentially, right, these funds, of course, they're earmarked, right, for certain specific purposes. I think when it comes to treasury diversification, I think I absolutely also see the risk that if you, of course, you can get more runway, but then if you're basically dropping your own native token at the wrong time, it can also really destroy basically your pricing, and I think also like, so to say, the user experience of the token holders. So I think what I see as the ideal outcome, if for really reasons like, hey, you really want to extend the runway, there's really a clear reason, there's a clear plan in place, you want to extend your runway, that you combine that with a strategic, let's say, win. So that maybe you can bring in somebody as a new token holder, which can bring new perspective to the ecosystem, where basically you can also make sure that these tokens are not just getting dropped like at the next possible opportunity. And I think that's, of course, now highly theoretical and abstract. And of course, I think it's really about chasing this perfection, which is certainly not an easy game. We will be looking at this challenge in the next couple of months once, of course, the token becomes transferable. It's certainly super exciting. And yeah, I guess, to be honest, I think there's also a great piece, I think, has been published in the past by Hasu on treasury diversification. And I think there's a great, and I don't take any position here, there's a great forum thread, I think, in the Lido community about, I think, some treasury diversification initiative, I think, with a VC fund. Just look at this, see the debates. It's often also all about transparency if you do this transactions. And I think it's super fascinating, but it's certainly not easy to conduct. And yeah, have a look. It's certainly super enjoyable.
I think that when we're speaking about treasury, we need to understand or to remember that we're not talking only about our native token. We're talking about all the treasury that we have. And most of the time, startups are talking about the runway, but sometimes there are some startups that are having revenue as well. So we shouldn't be gamblers. I think that everyone agree with that. So we should have a company should have a policy saying, like, usually, like, most of the funds will be in a zero risk. Some of them will be in a medium risk, and maybe a friction will be if you have a lot of treasury that you don't need for the next 24 months or so, you can have a friction of your treasury in a high risk investments. Remember that we are just dealing with other people's money, and we need to be very cautious, and need to be transparent and just work according to this policy. And if you have revenue, then actually your treasury is always changing because you're getting money in different tokens, and you need to manage this exposure as well. And like these days, I'm deeply involved in Inabit. It's a startup that's dealing exactly, one of the features is dealing exactly with that problem. Assuming that I want to be exposed to like 10 Bitcoins and I'm getting the 11th one or the 12th one, I need to swap it immediately to stablecoin. because if during the weekend the Bitcoin will decrease in 10%, I actually lost all the net revenue of this transaction. So there are many things that real finance teams in the Web3 should think about. And I think that this is, again, part of maturity of this industry. We cannot find CFOs with 12 years of experience in the Web3 economy. But we should learn from the traditional finance about how to manage the exposure, both of the treasury that we have and hedging and swapping the revenue that we are getting.
Yeah, just to add
ahead,
upon this, I usually tend to count like a native token treasury separately, or don't even count it as a part of the treasury, right? Because it's like as I said, it's the last way out if you're really in a trouble that you should sell your own token. Otherwise, it just as it acts as a means of to support your ecosystem as a whole. Otherwise, you have other funds that you need to support your business with.
Yeah, and I think for me also, like the starting point to all these discussions is really proper planning and budgeting, right? What are your actually like cash needs over a given period of time? And I can tell you, like, I don't know what's your experience there, but like it's safe, like you introduced like I think a budgeting process, and I still recall very vividly the first conversations we had with certain team leads as they for the first time had to build budgets, right? And it's like, especially in our industry where there's so much unknown how things will evolve in the near and also midterm term future. But you need to do it. It's a practice. You need to step up and improve every time you basic practices, because like that's also like a very essential part of essentially financial risk management, so to say.
Yeah.
The timer is running fast. I'm not sure if we'll have time to do the last topic, which is on the role of the Web3 CFO, but I do want to go through the topic on investing beyond crypto, so in Tbills, ETFs, and discuss a bit the conservative solutions. For example, right now with US bonds yielding 4.2 to 5% as of today. Nick, you released an interesting article on this. I will share this soon in the chat on how Web3 projects can invest in US government bonds through T-bills and ETFs. You provide some of the solutions there with traditional banking partners like Signum, VP Bank, other fintech solutions like Mercury, Zamp Finance, and on-chain solutions like the emerging on-chain solutions such as OpenDen and Ondo Finance. Ivan, you asked a similar question. I'll go through your question, but I want to ask you guys, with these on-chain solutions, have you been trying them and using your stable coins to generate additional yield?
Yeah, if I start, no, not really. I mean, I've spoken with most of those teams actually that are providing like on-chain solutions, but we haven't. I tested some of them, but we haven't decided to use it, not because of the, let's say, any problems with the platform or the project itself, but because it's for me, I still believe that the risk is still lower if we go, let's say, through a banking partner such as Signum, for example, or some other provider, let's say VP Bank, as we operated with them in Bitstamp. But I think the main problem here with a lot of crypto projects is the entry barrier, right? If you're going through a bank, you're required to meet a certain threshold, a certain minimum investment in order to be able to get direct exposure to the T-bills. Otherwise, your only option are the ETFs, which is another thing, right? I think also Ondo Finance offers the T-bill exposure on chain, but it's gone through the ETFs. So yeah, it really depends. That if you don't hold like a huge treasury in stable coins, you're not really able to invest through your traditional banking partners. So you have to select either some of the fintech solutions or an on-chain solution, right? But from what I see, maybe you still have to provide or to do your KYC with the on-chain solutions, because it's the regulation that's coming, right? And also the banking partners. For example, I can talk about Signum because I know what their process is. They tend to offer also an option for you to deploy stablecoins and invest them in the Tbills, which is pretty much similar solution to the on-chain Tbill providers. Not the same, but it's a similar mechanics, right? You actually deposit stablecoin, and then they purchase the Tbills in your name. And the on-chain solution is a bit different because you practically link your wallet and purchase let's say the token that's backed by Tbills in a sense. So the risks are a bit different, but essentially you have to decide which risk you want to take, right? So for the time being, I still think that going through a banking partner, if you know your threshold allows you to, or if your treasury size allows you to, it's still a bit safer from that perspective. On the other hand, if you hold like a lower treasury, lower size treasury, then you have other options as an on-chain or the fintech options, right? And it's still a better option than going through some other stablecoin yield generating solutions that were, let's say, popular when the yields were lower. For example, particularly the lending of stablecoins, right? I think the rates now are between 1% and 2%, if I'm not mistaken. So if you compare like 1% for the, let's say, crypto lending, and you have some counterparty risk there, most of the times you don't even know exactly what's behind, right, the project. And on the other hand, you have like I'd say that most of the on-chain providers are pretty, let's say, to an extent regulated and pretty transparent. And they offer you the T-bills yield, which is roughly 4 to 5%, which is much higher than actually lend your tokens. So yeah, that's my view.
It looks like Nick is really well educated about the T-bills on chain, and I have to admit that I'm still learning it. I do enjoy the high interest environment here, doing more than 5% on the fiat, using the traditional banking, still learning what's happening with the on-chain T-bills and other options. And when someone is telling that is backed with T-bills, I want to know that it's really backed with T-bills. In Fuse, we are thinking about taking T-bills onto the Fuse network, and then as part of this education, I assume that I will use it once it will be on the Fuse chain. But currently, if we are using any T-bills or similar things here in the traditional banks and having more than this 5%. So, and again, it's always not on all the treasury or on all the fiat. You always take just a portion according to the exposure policy of the company. Because as Ivan is just writing, like our duty is to make sure that we have enough funds in any case. So there is always amount that you are not allowing yourself to put in any risk. Because we don't need to get yield on the treasury. We need to run a company. We are not investors. Actually, we are using investors' money, and we need to be very cautious with that.
I think fully agree with both of you. Also, like it's really typically done really through traditional banking partners. We have a look, basically at this on-chain products. Two observations I have seen. First of all, there is not really a secondary market established to which you can really also then, for example, handle larger volumes. For example, in the case as we have closed a relatively sizable Series A, right? Secondly, if you want to basically obtain the token or redeem the token by the issuer, there are also quite some sizable fees involved, so which then also actually would consume a lot of the return. So in the end, yeah, it's then super nice, but in the bottom line, it was then probably not so much attractive. But of course, like I think fundamentally, the big plus I see with on-chain products is just like the radical transparency. Like if you, and we also, of course, of doing this like DAO reporting, right, of what we would be doing, you know, it's great to provide this visibility and transparency to our community, obviously. But it really also needs to make sense. And if you lock up yourself in products which don't have a secondary market, where you depend then on an issuer, and also like here again, counterparty risk, right? With a traditional bank, you have really established bank as a counterparty. With this more newer products, on-chain products, often you have relatively small issuing companies, and of course that's also a different, let's say, counterparty risk you would enter. But I'm super hyped to follow this sector or this product suite and see what comes next. I think tokenization, as we all know, is just that it just got started. Huh?
We have 13 minutes left. Before we do the Q&A, I just want to go through the last question, which is the role of the Web3 CFO for treasury management. So with the years of experience that you guys have, what advice would you have for Web3 companies looking to hire CFO, head of treasury, given now the enhanced responsibilities that they have for treasury management? And what are some of the skills that you expect this CFO to have? Hey, Kevin.
Yeah, sure. I think it's a very great question, and I feel like there's not the single answer for this. I feel like joining as a CFO, head of treasury, head of finance, a crypto project, often you're really literally the first person in finance. So I think you are expected to work on many strategic topics, but also very operational topics. So I think you need to be really like a versatile person, like happy, really an operator, an executor, but at the same time also strategic advice to the founders. So I think it calls for a lot. So it's probably hard, and I even apply that to me, right? I have certain experiences, but I might have other areas where I maybe not having, I don't display the same level of experience. And also, if you look at three of us, we all have a bit different backgrounds. I think this also already provides for a good, I think, interim of a first answer. Yeah, a doer, a hands-on operator. I think somebody who is really also willing to dive into topics. I personally recommend also get somebody who has a solid understanding of taxes, but I have also bias. I'm original tax lawyer.
Yeah, I think I can totally agree with Kevin. When thinking about a CFO to a Web3 company, I think that first of all, when someone hires a CFO, you hire a C-level person. So it needs to be a leader, someone that can be a counterparty to the CEO, that they're usually going to the product or to the marketing or to the investors, and they are the super salesmen, women of the company, of the product. And they need someone that will be there in the company as part of the C-suite. It shouldn't be someone that having like this 10 years of experience in Web3, because they will not be able to hire anyone. I think that the CFO should be someone that understands how business works, how money works, and that's for any CFO. But for the Web3, it should be kind of, the CFO should be kind of a nerd. Sorry, guys, that likes the technology, that knows how to deal with that, not to be afraid of changes, or even maybe a little bit environment that is changing rapidly, and know how to manage in this situation. So I think that these are the things that I would like to see in Web3 CFOs. And there are always things that we don't know, like treasury management or doing the market making. So I think that one should know what he doesn't know. Like, I don't know how to do a hands-on market making. So I will hire someone, or I will hire a service, someone that I trust. It can either be a service provider, or I'm just hiring someone in-house to do the market making and to manage it for the community, which is something that you don't have in traditional finance. So I think that these are the difference between traditional CFOs and the Web3 ones. This is the techie part, and to know how to learn fast technology and to adapt to changes as rapidly.
Yeah, if I had a point, is I think that you guys probably covered the main topics, but I say that it definitely needs to have like some sort of hands-on experience, or at least willing to do it, because particularly at the early stage of the companies, the startups, you will have to do all sorts of different tasks. But also, I'd say that unless you're joining like some already established crypto company, which there are probably like 10, 20, maybe 30 of them that are pretty big at the moment, and your let's say CFO role is like similar as in a traditional finance, let's say similar, you will most probably have to build your own team from the ground up, right? You have to build a team, you have to set up the processes. So that's also, I think, important for a person to either have some experience or at least they know what let's say is expected from them.
Yeah, absolutely. Processes are a big chunk of being a CFO. I think that, and there are solutions, by the way. If you're familiar with processes from TradFi, you can just bring them into a Web3 companies and looking for solutions that will allow you to do that. Like signatory rights was a huge hassle for me, like because there is no bank that managing it. Anyone can sign, you just need to have the password. So these kind of solutions that we need to look for.
We do have some time left for Q&A. I've seen a couple of questions come in the chat bar. I'm going to just scroll on top. I see there's a question from Chirag Mehta. I'm going to read it. If we keep a large part of the treasury in USDC or Bitcoin, where will the liquidity come to swap the native token for the other tokens? Does anyone want to take this question?
So
it was the first.
When you need to liquidate USDC, you just go to Circle. That's the promise of Circle, that they will give you $1 for every USDC that you're going to send them. So if you pass the KYC of Circle, that's not an issue. And for the Bitcoin, I think that's like Bitcoin is one of the most like this is the token with one of the highest liquidities, if not the highest. I'm not following it actually because I'm not trading with Bitcoin. I don't think that should be an issue. If you want to liquidate your own token, I agree that I'm looking at, maybe because my past in traded companies, I look on the token as a traditional equity. It's not something that we should, as Nick mentioned a few times, it's not something that we should sell on a daily basis. We shouldn't use our own token on a daily basis.
Yeah, and I think like also like something I've learned over the last couple of years is also then exactly for this purpose, establish also like a trusted network of partners who can assist you also executing these swaps, for example, like I particularly refer here, for example, to OTC desks. So for example, I also just like get onboarded, as I outlined before, right? It's also part of the preparation, so to say, not just trying to use the service when you need them, be already onboarded with them, that you can also then, in case it's really necessary, act.
Yeah, definitely. And also, as Kevin said, the partnership with market makers and OTC desks are definitely important if you need to liquidate like a larger amounts of either, I don't know, stable coins or your native tokens. But I'd also point out that what is also equally important is that you try to get your token on the major exchanges, right? Because this is where you get the liquidity. And if you, let's say in the worst case scenario, if you need to sell, or also if the larger users want to buy your token needs to be listed on large exchanges. Otherwise, with the, let's say, sustainable, I mean, with the significant size will actually enter your token and your volume is pretty low. And if the volume is pretty low, then we all know what can happen with the token, right?
If you guys have any more questions, please drop them in the chat bar. We do have 4 minutes left. If you guys have any questions for each other as well. Or if not, that's okay. Yeah, so we can end the webinar. Thanks a lot, everyone, for coming today. Thanks to all our speakers. Thanks, Ivan, for staying up this late, because Ivan is actually based in Singapore, so I think it's 1 a.m. there. So thanks for staying up that late. And
Cosmos.
You know, you got me. Like I am also involved in a Cosmos SDK Fuel project as a board member. So yeah, not for the foreseeable future, because like I think the focus of multi-chain with Safe is very much on the EVM and the Ethereum community. So that's what I can say. But let's keep hoping and dreaming. Or somebody building a great multi-sig smart account solution with Cosmos. Please do it. It's necessary.
thank you.
Omer, thank you for having us. I think that you are running a great club, and I love it. I learned so much from this community. Amazing job. Thank you for doing that.
Yeah, thank you. It's not just me; it's the whole team at Request Network. Everyone's doing a fantastic
That's
job.
a humble guy.
Oh, I'm not. I mean, it's the truth.
No, thank you all. Thank you, Request, for doing this, for having
You're
this.
welcome.
Thank
For
you
any
very much.
other future webinars, like just let me know the title. I'm always listening to what the members are saying to come up with these webinar titles. So do let me know what should be the other webinar we should have. And until then, we'll speak on Slack.
All right. Thanks so much. See you
Thanks
guys.
a lot.
Thank you.
Cheers.
Cheers.
Bye.